Futures on the rise this morning slightly after falling on interest rate worries yesterday. The yield curve remaining inverted. You take a look at the 2-year yield and the 10-year. 2-year is higher than the 10-year yield, historically a sign of recession. It's been like that for how long? Mahoney Asset Management CEO Ken Mahoney is here. We're also, Ken, good morning. Looking ahead to Federal Reserve Chief Jay Powell speaking tomorrow. What are you expecting there? And do you think that the stock market is finally waking up to what the bond market's been telling us about a recession and maybe a profits recession as well?
Yeah, we've had that kind of 10-2, reversal, inverted at least. But, going back to the Fed Chair Powell, I think he's going to stay along the lines which he did in Jackson Hole, which was basically pretty belligerent. That 8-minute speech, it's about $1.2 trillion. Do the math on it. And I think where investors are right now, Dagan, is there's a crisis of confidence. And it starts with Fed Chair Powell, quite frankly. Where last year, what a big whiff. I mean, last year, great opportunity to raise rates a little bit. Instead, they told us inflation was transitory. Up until the time, by the way, that he was reappointed, then he said, well, let's retire the word transitory. Well, that's probably the time we should have retired him. And then you look at this administration, it literally is the teleprompter presidency. He goes up, he reads a little thingy, sits down, tries to shake air. I mean, no one has confidence in what's happening. Well, Michael said before in the Arizona independence, it's hard to get around this. Now, don't play too much defense. I mean, probably too late to short here. A lot of people are new to this, and so 7 down days in a row in NASDAQ. We're due for a one-day wonder, and maybe off the heels of what Powell says tomorrow, and maybe the CPI next week or the PPI next week. But I think he's going to, again, I don't think much has changed since Jackson Hole and what he's going to say tomorrow. So expect this kind of very hawkish tone, overreacting from last year's big whiff.
Mike Lee, jump in here.
Hey, Ken, every time we've rallied this significantly off the low, so from the trough to peak, we were up 17% off the June lows. Historically, the market has never either retested or made new lows. Given that we are in such an unprecedented environment, do you think that historical trend holds true, or do you think we test these lows or even make new lows going forward?
Good question, Michael. So I'm hoping we have a higher low. I guess that's what we're hoping for. I hope we don't have to look back. I mean, that low, by the way, the S&P 500 is about 36. We closed a tad on 3,900 yesterday. So you're right. That's about 7-8% from here, and we're at the June lows. And not a lot has changed since then. But again, I think at the moment, we have a lot of hedges, institutions. We see the short sales. I think a lot of investors are kind of off sides here. So if we could squeeze them a little bit, Michael, maybe we can get a little lift here. But we're hoping for a higher low and on the basis of, hey, we're pricing in a lot. We're pricing in a near Armageddon. And we're hoping that, again, the technicals can support that 36 level for the S&P 500.
But Morgan Stanley is saying that stocks have further to fall this year, another 23% as investors shift their focus to slowing growth. So you disagree, Ken?
Again, I mean, anything's possible, especially anything's come out of left field with the Fed rate hikes. This is just the opposite of last year. We have multiples contracting. The dollar's very strong. That's hurting multinationals. So you can't take anything off the table. But we're hoping that 36 is some type of defense, some type of support, meaning institutions are willing to buy that level, and we're hoping that holds. But, again, they could be right as well, because we're in this uncertain time. Again, lack of leadership, and, of course, the Federal Reserve, they're known to whiff.
Well, how do you allocate money here?
So one good hedge, I think, for investors is XLE, the energy ETF. We've had this kind of seesaw battle all year long. Oil receded mid-July, and then we saw stocks take off. Now we've seen oil creep up and saw stocks go lower. So XLE would be a good hedge for your portfolio. We also like pair trades of Microsoft as a long, buying Microsoft here in pullback based on their earnings, 6-9% margins. They're buying back more stock, raising their dividends, raising guidance. And you pair that with a short. Easy short here into rallies would be Meta, and that is Zucker and all the things that's wrong with them. And of course, remember, their business model has changed. They're not able to rifle our information and then sell it to third parties, not know where it goes. They literally have to play by the game now, and that is Apple kind of put a kibosh on that. Also, remember, Meta's now put tens of billions of dollars into this metaverse, which is really a niche. It's not got wide acceptance. So I think there's a few plays that investors can have. One, XLE as a hedge against all that's happening. And also, if you want to kind of dip your toe back in technology, a pair trade, which kind of makes it market neutral, buying Microsoft and shorting Meta.
A lot of discussion before 6:20 this morning about bodily functions between you and Mike Lee. Ken Mahoney, thank you. Thank you so much. And I'm the one watching my mouth. I mean, what's the world come to? Ken, great to see you this morning. Thank you so much. Great. Ken Mahoney.